Imagine rolling a snowball downhill. It starts off small, but quickly gains momentum, growing bigger and faster with each passing moment. By the time it reaches the bottom, it becomes a mighty mound of snow, much larger than when we began. Now think of this in terms of investing in real life. The snowball represents an investment portfolio. As time goes by, the investment receives more dividends along the way. When we reinvest these dividends, the portfolio grows, just like the snowball rolling downhill. This process is called compounding. As Albert Einstein famously said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." In this video, we will explore how does the snowball effect work? What is the best strategy? What should we invest in? And how much can we potentially make if we contribute $100 per month? At the end, we will unveil a portfolio to maximize the benefits of compounding, helping you to earn more passive income than your full-time job every month. Let's take a closer look at investing in PepsiCo to understand how the snowball strategy works. PepsiCo is the largest food and beverage company in North America. It owns a wide range of brands like Pepsi, Gatorade, and Frito-Lay. What's impressive about PepsiCo is that the company has been raising its dividends for 50 years straight. Over the past decade, the dividend's compound annual growth rate, also known as CAGR, has been 8.24%. The share price has been appreciating at a rate of 7.25% per year. This means that both the dividends and the value of the company's stock have been steadily growing over time. Let's say you invest $1,000 in PepsiCo. After 20 years, if you don't reinvest your dividends, your investment would grow to $4,055. However, if you choose to reinvest those dividends, your investment would skyrocket to $7,019. There is a huge difference of $2,964, which means you would earn 73% more by reinvesting your dividends. How about patiently waiting 10 more years? You will have $8,164 without dividend reinvestment. If you reinvested those dividends, you will have $19,355. Now there is a massive difference of $11,191, or 137% more with reinvesting your dividends. This amazing growth happens because of the compounding effect. Each time you receive a dividend, your dividend buys more shares for you. With more shares, you will receive even more dividends next time. This cycle repeats itself, causing your investment to snowball into something truly remarkable over time. If you are a highly motivated individual and you would like to contribute an extra $100 per month in the investment after the initial investment of $1,000, after 20 years, you only invest $25,000. 30 years later, you will invest $37,000. Let's see how much more you can potentially earn. By the end of 20 years, you would have $54,613 in the investment portfolio without dividend reinvestment. With dividend reinvestment, you will have $78,178 in the portfolio. There is a $23,565 difference. In another word, you are missing 43% without dividend reinvestment. Now, let's fast forward to 30 years. Without dividend reinvestment, you would have $126,746 in the portfolio. By reinvesting those dividends, it would soar to $235,389. There is $108,643 in difference, or you would gain 86% more by reinvesting. The longer you wait, the bigger the difference becomes. No matter how modest your savings may be at present, the earlier you start investing, the sooner you can unleash the power of the eighth wonder of the world, compound interest. Time is your ally in this journey. The more time you give your investment to grow, the greater the rewards will be in the long run. Now that you understand the power of the snowball effect, you might be wondering, what should we invest in? Before jumping into any investment, let's consider the wise words Warren Buffett said. The snowball just happens if you are in the right kind of snow, And that's what happened with me. With thousands of stocks available in the market, not all of them can be your snowball. We have 3 types of investments that could be your snowball. First on the list are dividend aristocrats. To earn this title, companies must consistently increase dividends for at least 25 years. These companies have been successful for many years and generate great cash flow. When picking these stocks, make sure the payout ratio is between 50% and 70%. Payout ratio is the amount of dividends paid out to shareholders relative to the profit. Let's say a company made $1 million in profit and distributed $500,000 to shareholders. Then the payout ratio is 500,000 divided by 1 million is equal to 0.5, which is 50%. If the payout ratio is too high, at 80% to 90%, then the company might not have money for future growth. If it is over 100%, that means the company is distributing more money than they earn. This is unsustainable. However, this measure does not apply to REITs. Target Corporation is a great example of dividend aristocrats, boasting a payout ratio of 69% and a streak of increasing dividend for 53 consecutive years. It has an amazing 10-year CAGR of 10.68% for its dividend, with an average return of 9.72% in the past 10 years. Next on the list are high dividend ETFs. Picking individual dividend stocks could be challenging and time-consuming. Plus, companies can reduce or cancel dividend payments unexpectedly. That's where high dividend ETFs come in handy. A high dividend ETF holds a pool of stocks. If one stock suddenly reduces or cancels dividend payment, it does not affect the dividend income since the rest of the stocks are still paying. A standout example of a high dividend ETF is Vanguard High Dividend Yield Index ETF, ticker symbol VYM. VYM has a dividend yield of 3.12%. In the past 10 years, VYM had an impressive CAGR of 7.12% in dividend, with an average return of 9.91%. Lastly, let's talk about real estate investment trusts, or REITs. These are companies that own and manage commercial real estate properties like apartments, hotels, and shopping malls. Investing in REITs is a fantastic option for individual investors who may not have sufficient funds to purchase properties but still want to be part of the real estate market. One major benefit is that we don't need to deal with day-to-day hassles of the property management. The company takes care of all that for us. When we need cash, we are able to sell our shares right away and get cash back. Unlike physical properties, where selling requires working with realtors and it can take time. A great example of REITs is Realty Income, ticker symbol O. Realty Income offers a dividend yield of 5.4%. In the past 10 years, Realty Income had a CAGR of 3.79% in dividend, and the average return in share price is at 4.66%. Let's build an investment portfolio with each type of snow. For the Dividend Aristocrat, we will choose NextEra Energy, Inc., with the ticker symbol NEE. NEE has a dividend yield of 3.57% and the 10-year dividend CAGR of 10.98%. For the High Dividend Yield ETF, we will go with iShares Core Dividend Growth ETF, ticker symbol DGRO. DGRO offers a dividend yield of 2.36% and the 10-year dividend CAGR is 19.86%. For the REIT, we will select Agree Realty Corporation, ticker symbol ADC. ADC has a dividend yield of 5.30% and the 10-year dividend yield of 8.22%. In 20 years, with dividend reinvestment, NEE would be $39,177. DGRO would be $24,895, and ADC would be $25,279. The total value of the investment portfolio would be $89,351. The total dividend earned in the 20th year is $25,199. translating to a monthly dividend income of $2,100. This amount can definitely support part of your living expenses. How about investing $100 every month after the initial $1,000 and continue to reinvest dividends? After 20 years, NEE would be $304,495. DGRO would be $243,088, and ADC would be $205,076. The total value of this investment portfolio is $752,659. The annual dividend is $218,957. That's an impressive $18,246 in dividends each month. By investing an extra $100 per month, your investment will be significantly higher than the strategy without reinvesting. This passive income could significantly improve your quality of life. Finding the right type of investment and letting it run as long as possible can lead to the best result. Like the snowball, your investment might start small and gain momentum slowly. If you can patiently wait and constantly contribute a certain amount every year, your portfolio would grow much faster and bigger. The longer you wait, the greater momentum you will see. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See ya in the next video.